Looks like a synthetic long. Are you sure it's not an in the money straddle? So the last time they shorted really hard and they were selling the IV on Upstart, they kept opening in the money straddles on it, which are like vol exposure. I wouldn't assume it's synthetic long based off just the bid ask. And it looked like the last time it looked like synthetic long too. That was back in January. And it looked like people were going synthetic long and super bullish. But then the more the position built up, as IV began to skew, it became more apparent that they were like opening in the money straddles. Well, those puts weren't so bullish after all. For lithium, I would go for ALB. That's what we were talking about. Why are they refraining to short to death the meme basket? Jamie specifically, usually by now, they would have already very aggressively. I mean, we're already approaching OPEX area. Weird. I mean, generally, aggressive shorting doesn't begin until after the resolution of ETF FTDs. Once they have ETF liquidity, they can short a lot harder. But also, they don't really need to short the price very much right now because IV already dumped so hard, right? So if they start buying lots of in the money puts to push GME's price down, they're going to spike IV up. And that may not be something they want to do just yet. Also, it's a lot easier to short it when you have active fund pressure working in your favor. You're trying to short it right now when arbitrage is negative and you're kind of just ramming your head against a wall. When you can wait till you have a little bit more liquidity next week and active funds are selling off, providing even more additional liquidity, right? I mean, like, ultimately, it's all about profitability and the position on GameStop, right? And you know, GameStop, especially when it's illiquid, right? And you know, those charts that we show you guys aren't really liquidity. Like liquidity is like Lex charts. If you want just like raw liquidity values, the charts we're showing you are more of the effect of low liquidity on the profitability of positioning on GME, right? So as GME becomes more illiquid, by that chart standard, by the tips, it means that it is less profitable to short, right? So, you know, when it reaches those peaks, there's no more value in the short position. So, you know, synthetic liquidity created here's variance over time is going to like net neutral. And so, you know, why push harder, you know? And so it's not advantageous to short it here. There's no benefit. What's to say active fund pressure will switch bearish? Nothing. But I mean, they can wait forever, right? There's no rush. There's no pressure. They've already sold massive amounts of calls at like, you know, 23, 24, 25, 30 naked. They don't give a shit, right? They don't need to short. They can just let these decay. Like, they sucked the volatility out of Jimmy in like a day. Thanks, DRS. So the more illiquid the stock becomes, the less incentive to short. So DRS will continue to drive less shorting. Well, DRS makes shorting more efficient, right? So DRS doesn't remove liquidity. Right, DRS, this is complex, so let me think of how to break this down. DRS removes supply, which increases price volatility. Price volatility. This is not implied volatility. Price volatility is the amount of capital necessary to move the price of the stock, say by like $1 in either direction. This is a good way to think of it, right? So DRS increases price volatility, but it increases it both to the up and downside. So if, institutional pressure is down, it makes it cheaper to drop the price with fewer shorts necessary to do so. So it compresses liquidity. Liquidity itself is infinite, right? And that's why I say, like, the chart we show you guys isn't representative of liquidity. They can always get more liquidity, but eventually the more liquidity they're getting, it's not doing anything anymore, right? There's like there's an upper limit to the profitability of that synthetic liquidity. So, in this range here, shares created can be either returned or cash settled cheaper in the future, right? Because shorting in this range will drop the price significantly, right? But once you start to get into the upper limit, shorts created here, there's no profitability on them over time, right? So now you're just creating synthetics for nothing. There's no more value in creating them. And this is where it's beneficial for them to have a liquidity event, because that means the stock becomes more liquid again, which means that created shares become profitable again. I thought DRS was about showing stock manipulation. It doesn't do that at all.